When we think about the 2008 financial crisis, the trigger for things going from bad to worse is usually believed to be Lehman Brothers going bankrupt. But a lot of other pretty catastrophic things happened before Lehman declared Chapter 11. The subprime mortgage market collapsed in August of 2007. Bear Stearns saw its stock price collapse to the point where JP Morgan Chase bought it for only $10 a share, with a huge assist from the U.S. Federal Reserve. In the week before Lehman went bankrupt, the U.S. government took control of Fannie Mae and Freddie Mac. The day after Lehman went bankrupt, the Treasury Department rescued AIG. In fact, when Lehman had to declare bankruptcy, many commentators actually applauded, because it was thought that the U.S. government would no longer intervene in the free market, and there would be no more bailouts. Of course, that only lasted one day, because then AIG was bailed out. Lehman was the most important domino precisely because it declared bankruptcy. That event had two immediate and unanticipated effects. First, it left many hedge funds high and dry. Lehman had been engaging in rehypothecation, loaning out hedge fund collateral to others on a very short-term basis. By declaring bankruptcy, however, those short-term loans could not be paid back. So these hedge funds could no longer access their collateral, which left them in a very precarious financial position. Hedge funds had no insurance or government protection. They weren't regulated. And if this could happen to Lehman, hedge fund managers realized it could happen with other investment banks. So hedge funds started demanding redemptions, i.e. their money, from other investment banks, like Goldman Sachs and Morgan Stanley. But these investment banks were even less well capitalized than commercial banks. They felt the stress of people demanding their capital and stopped loaning out money themselves. Lehman collapsing put immediate pressure on hedge funds and other investment banks. The other way Lehman's bankruptcy mattered was through its effect on money market funds. These are funds that do little more than hold very liquid, very safe assets, like U.S. Treasury bills. They do not earn a great rate of return, but were thought to be the safest assets. In 2008, the Reserve Primary Fund offered the highest rate of those funds by being just a little bit riskier. Unfortunately for them, they were able to do that by investing their money in, wait for it, Lehman Brothers. When Lehman declared bankruptcy, the Reserve Primary Fund lost more than $780 million, and it could no longer offer its investors at least $1 in return for an invested dollar. It broke the buck and could only offer 97 cents. This caused a more general panic in financial markets. If even money market funds could not be trusted, then there was no safe asset. So all investors started seeking redemptions or withdrawals of holdings that were not insured by the government. And those funds, in turn, had to start selling off their assets and stop loaning in order to be able to pay back their clients. And that, in turn, caused financial institutions to stop lending to each other. The LIBOR, London Interbank Offered Rate, skyrocketed. Credit dried up. Bankers sought liquidity and stopped lending to each other. This caused real U.S. economic activity to slump, and it caused a similar panic about foreign banks with ties to the U.S. financial sector. And that is why Lehman going bankrupt was the trigger for the 2008 financial crisis.